Welcome back, everyone, to the Mortgage Heroes Weekly Podcast, where we talk about how you can win in mortgage and real estate. Each week, we have a new topic to discuss and dig into. We share opinion, perspective, advice, and insight that helps to bring forward the most important topics of the market to the table. I'm Andy Cruz in Business Development, and today I have with me
Brian Landeros
and Will Flores.
So last week, guys, gave us a great product breakdown of the 3-2-1 buy down and how aspiring buyers can use it today to help achieve their home ownership goals. I know you guys did that solo together without me. How did it go?
Andy, it's good to have you back.
Well, I'll definitely say my intro was not as crisp as yours, so it's good to have you back. But other than that, I think we did great. Honestly, I mean, it's like stuff that me and Will talk about all the time, so it was really easy to just be able to,
And one of the things, I think you did phenomenal, Brian. One of the things is we're just giving information out, right? We're not here to...
Not a perfect
You're
guy.
not the weather forecaster, okay?
I'm not, unfortunately.
No, it was great. I did listen to the playback. I watched the whole thing, and you guys did a good job. So awesome job hosting the show.
Andy.
Awesome job guesting again.
Yeah.
But also, if anyone that's listening to this had missed that show, you can go back one episode and look at the 3-2-1 buy down and how people are using it right now in the market to take advantage if you're a seller, or also if you're a buyer, in order to kind of avert some of the high rate environment we're living in, and get yourself into a great situation now, so you're in the market versus on the outside looking in. 100%.
Golly, Andy. Good to have you back, Andy.
There we go. We are back. We are on to
so
a new
refreshed.
show.
So refreshed.
So new show topic for today, guys.
Yes.
I know I prepped you for a couple things like normal. I'm going to prep the guys for a couple things, and then I'm going to catch them a little bit and ask some questions they don't know about. So today's topic is we're going to look at the kinds of things you're hearing current homeowners talk about so far in 2023. And we're going to talk about some headlines real quickly first. We're going to go to headlines of 2022 that kind of dominated this bag of topics, right? So here's some of the things we heard about to end the year. Then we'll jump into some things we're hearing about so far in 2023. So first things first is we heard about inflation. We heard about the Fed increasing rates, and home prices are going to crash. Banks and hedge funds are creating large funds to buy up homes. Interest rates are high. ADUs are taking off, but they take a long time. The collapse of iBuying and Zillow, Open Door, and others, and then banks laying off thousands of people. So that's kind of the collection of things I heard coming into the end of 2022. What'd you guys hear about at the end of the year? Anything other than those things?
Jeez.
So, I mean, one of the things that we're still continuing to hear is compared to previous years, home prices are a little bit lower. Not a lot of it, but they're starting to dip. So that's one of the things that I have heard prospective homeowners and homeowners already start to come out and say that they're already noticing it as well. I mean, we're not seeing a crazy crash or anything yet, and I don't think we will. But they are a little bit more affordable than what they were previous months and even 2 to 3 years ago.
Okay. All right.
Yeah, and like we mentioned before, Brian, I don't think we've seen such a huge dip like that because, again, it's all about the supply that we have of homes, right? The more supply we have, it's just simple economics. You know, and so in this case, we don't have as many properties. And therefore, the property prices have not dipped to where people were expecting them back in 2008, et cetera. That's when we had a lot of properties.
Yeah, and like we've discussed, we kicked around a little bit before, like the reason I think we're not having a crash like everyone's saying there's going to be is because of that effect, right? There's the supply issue, number one, and then also just the cost of borrowing has made people second guess or third guess, fourth guess, like maybe I don't want to do this. We're still telling people though, like, hey, you're going to pay for something. So you're either going to pay rent, which is someone else's mortgage, or you're going to pay your own. Just choose which one you're going to pay.
That's agreed.
So I think, again, also the correction territory is more about where is it happening? Not just in every area is the same. So I think you got to look at that too.
Do you guys know what the foreclosure rate has been this year around?
You mean in
how much
2022?
in percentage? Yeah, no, actually 2023 it started.
Oh, I don't know that.
From last year, it's gone up 115%.
Oh, wow.
All right, but of what?
Yeah.
115 of what, 10?
Foreclosures, yeah, exactly.
There were 10, now there's 20?
You see what I'm saying? So we don't see all that because the people are... It's just banks are dealing with these foreclosures a lot differently. Yeah.
I think I was just telling someone earlier that I think that we're going to start seeing workouts again because the banks are going to have to make a decision. Again, this goes to mortgage servicing. Those of you who are listening don't know what mortgage servicing is. It's who you're making your payment to every single month. You get a bill in the mail. or you pay online, you're paying it to the mortgage servicer. It may actually be the same company that is holding your mortgage. Yep. In some cases, it's not. But they're going to have to make workouts with people that if they come under unemployment or they come under more financial duress, it's better for them in most cases to figure out a workout situation than it is to take back the home, put it on the market, take an even deeper haircut than they would have by just working it out.
And I can't recall like the exact numbers of what equity was back in 2008 when we started seeing everything crash because obviously I wasn't in the industry. But luckily I have Will and I have Andy. Yeah. So compared to back then, equity right now is probably still at the highest since pre-pandemic levels. Can we all agree?
Yes.
Yeah. So compared to 2008, how are the equity levels compared to what they are now? Meaning that the banks are more lenient to want to work with the home buyer because they have equity in the house instead of him just selling it off because they're not making any money on it.
That's a good point, but there's two things to remember. Number one, people were maxed out to the hilt a lot of times in 2006, 7, and 8. They had higher LTVs, if you will. But also, on the contrary, now, because there is so much equity, banks might be inclined to sell as long as there's money left on the table after. So I honestly think that threshold is 70 cents on the dollar. Again, I don't do this. I don't do mortgage servicing. But what we've seen in the past is they incur expenses to list and sell a home, market a home, process that entire transaction. That already cuts them out from 100% earning to maybe, let's say, 95% or 85%. So if there's equity in the house, I could see them coming to the market with some, but not a glut of homes like before. Because before, it was just a loss from the beginning. I think there's some math this time you could do to figure out whether it's a loss or not.
Yeah. And even for homeowners as well, that they're like probably, to the neck with not being able to pay or their bills, they could still sell in a strategic way where, they'll either have it a wash or, enough for them to just make out and be free and clear of whatever, was coming towards them.
Yeah. How many people walked just because they're like, I owe more than this place is worth. I'm just done.
Here's your keys.
But now,
take it back.
But now people can sell and maybe get themselves out of some financial trouble that may have been causing some.
And I guess that was the point that I'm trying to drive home, where now it's more lucrative for them to be able to sell and be able to either make a profit or still just, walk away free and clear instead of like now carrying the debt, carrying the foreclosure, and then having a bankrupt or, worse matters.
Right. They always say history repeats itself, right? But in a different way. This way around, COVID taught us a lot. We had those forbearance payments, 2012, they started doing more loan modifications. So banks noticed that the foreclosure proceedings just was costing them all the money. We have to hire an attorney. We have to do this. So what do our investors really want? Maybe they want some type of an agreement, and let's work towards that.
Yeah.
And that's where banks and the community become more profitable, is by having a workout.
And like we experienced back then, it's also not the business they're in. They're not in the business of taking back real estate and then selling real estate. They finance transactions. They're not trying to hold maybe they are now, but I'm saying back then, that was not the game. It was, we need to recuperate as much as we can as fast as possible.
That's correct. I mean, kind of same similarities, right? But you have Open Door, right?
Right.
They were doing the whole iBuying, selling real estate, thinking they're real estate agents. Where are they at now? Just Google them.
Yeah.
Zillow, Google them. You'll see what their stock has been doing.
Yeah.
So this market really, it's all about, boots on ground.
Yeah. Oh yeah, for
100%.
sure.
Yeah.
And so it takes a lot of work, right? And it takes a lot of understanding about your community and how you're going to be able to help it. So that's where.
It's funny because I've always argued, in some cases it's more of an argument or less, that there's always a level of personalization that's going to be included in real estate and mortgage.
Yes.
Because I don't make big decisions just on my computer screen without a person's involvement.
Yeah.
Because I want to ask my doctor certain questions, my attorney certain questions, my tax person certain questions. I don't ask the internet for everything and then just make a decision based on what its results give me,
and that's
including real estate and mortgage.
And that's what we see a lot, where everybody goes to the internet and tries to see that, real estate's a one size fits all. But then when they actually come to, to actually do their mortgage or actually buy a house, you realize that it's more personalized and not a one size fits all for everybody, because nobody has the same situation. Nobody goes through the same obstacles. Nobody has the same financial profile. So every loan, every purchase is a lot different.
That's what makes this business fun. Everything's different.
And that's what I told Will. Like, I'm like, it's like a puzzle. Like, how am I going to put this one together so that the client can reach their goal and we could all be happy?
You do puzzles?
Yeah. It's like mortgage puzzles.
You got to do one. We got to do, it's not about always Monopoly. I know it gets us to.
This box says 12 and up. You're up.
Yeah,
Brian,
exactly. Yeah. Puzzles. There we go.
So let's migrate then into some 2023. We're a couple of weeks into the new year. year, what are people already talking to you guys about or asking you about?
Some of the things that I'm still hearing similarities is they're having a hard time finding a home. They're still finding a hard time. And so my response to that is, I've been doing this for 16 years. I've always noticed kind of the same trend, January, February. You know, people already did their money spending for Christmas, did the holidays. They're kind of like, do I want to put my house on the market, or do I really want to go out there and buy a home right now?
Probably waiting for that tax return that comes,
Yes, there you go. That was actually a conversation that I had today with the client. We're like, want to pay some debt off. We're going to wait until we do our taxes so that we can, reduce our debt to income and qualify for more. Okay. So, that's the great thing about understanding and meeting with your clients and helping them understand the debt to income ratios, et cetera, of what their affordability is going to be. So that's one of the things that they're actually talking about, you know?
Okay.
And so hopefully we can, builders, we need more homes.
So, that's a whole different topic.
Yeah. So what I was going with that is usually January, February is going to be your slowest, right? March, it starts picking up. Spring, that's why they call it spring forward, like you will spring forward your clock. That's where we start seeing a lot more activity coming in, more houses, sellers want to put their house now there. Okay. It's a little, it's not raining as much anymore. It's not as cold, and the holidays are over. So it's time for me to get going here. So that's usually the trend.
Okay. So people are talking to you about like more preparatory stuff now. Like,
that's
hey,
correct.
I'm thinking of doing this, or I want to do that. Okay. So they themselves are still thawing out, if you will.
Yeah.
Okay. What about you? What's something you're hearing about so far in 2023?
To follow up to what he mentioned earlier is a lot of people are asking for more information, and they want to understand what's really happening with the market, right? Before, like when the rates were low, they didn't have to understand. All they knew there was low payment, low rate, great, right?
Sure, that was the deal. Let me get the deal.
Right?
Yeah.
So now
it's good days.
Now it's more like, okay, let me do tons of research. Let me really know what's going on. And then now they're asking for content, or they're doing their research to go look for content that's going to help them figure out their solution. So one of the things that, we have been very proactive in is sending the clients the content, showing them what's really happening in the forefront, and then having them understand what's really happening in the community level, not just national level, because I feel it gets very diluted when we're talking about what's happening national level compared to your micro market.
Sure.
So I feel more than anything, at least the clients that I've been speaking to, and the leads that we've been getting encountered with, is that they want more information so that they're able to understand how this market, how this situation is going to either help them or hinder them in their next move or next purchase.
No, it's true.
What things are they asking?
So
they want more information. That's great.
So,
is it about rates specifically?
So
is it about programs?
When can we expect rates to lower? Or why are they going up? What's causing them to go up, right? And I think that's the biggest one where people, everybody in the real estate market, the Fed, just raised, the Fed just talked about this. But what does that really mean for somebody that doesn't understand? And what impact do their decisions directly make in my life, in my everyday life? Well, we're seeing it. Things get more expensive, right? Their bills are going up. Energy's going up. Consumption of goods and services is going up. So what does that lead to? If I'm going to make a move here in the next couple of months, well, how is my finances going to be looking, right? So I feel everybody's trying to prepare to have the right plan, so when the right opportunity does come, they can make it confidently.
That's good.
It's so true.
That's
I had a grin earlier when you were saying all that, because why didn't I think of that? It's the same thing. I'm actually going through more emails now answering those type of questions,
Yes.
So what do you think the market is going to happen in 2-3 months with the housing? Their price is going to go down. What do you see the rates? And we have to be paying attention to all the market indicators, because we already see on February 1st with the Fed meeting,
That's states.
Exactly. And they come and they increase those little things will just change the way we see things, the way we're doing things.
Yeah.
So all these little things do matter.
I think one of the things, a big takeaway for me at the end of the year, but it's also, it's being talked about with me because it's more economic stuff, but it's about how people are realizing the impact the Fed has in the variety of things in their life. Because it was kind of one dimensional. Oh, they changed their rates. So this one thing in my life is going to go up. Well, okay, that may be true for like maybe your car rate's higher, or your line of credit or your credit card rate is higher. That's fine because they're adjustable. They're connected to Prime, which is connected to the Fed rate. But what is second and third order impacts are, companies that rely on corporate lending in order to produce their goods and get them to shelves are also increasing their prices because the cost of them borrowing the money to make the thing also costs. That's starting to happen. We go, wait a minute, I didn't think about that.
Yeah.
They have a $100,000 line of credit that they use to manufacture the socks I like. And then those socks go on the shelf, and why are my socks more expensive? Yeah. Well, it might just be because of cotton or whatever, but it's also because the company that makes it is borrowing the money to make them.
Yeah, exactly.
That is starting to come up more than I was expecting, but people are noticing that now too. So that's
correct.
That bag, that mixed in that bag of stuff.
They're starting to see everything just happen, and it's really unfolding in a way that it's like, wow, it's here. When it has been happening, and people could have eased into it if they were aware, had the information to them. But it has been. But I just feel people are very thawing out.
Yeah, it's kind of like if there's no pain, there's no pain. Yeah. Oh wait, hold on, this starts to hurt a little bit. What's hurting me? And they look and they go, oh, okay, hold on, I see this stuff happening now. Okay, all right.
I think everybody's changing right now. I mean, things aren't like they used to be.
Yeah,
you know, and like things used to be. I'm just talking about a few months ago.
Yeah.
That's how fast all of this has changed. You know, so I was just glad to see inflation go down a little bit here. You know, it was good. So I'm also starting to see more optimism from people.
Yes,
like they're more good. Like, okay, hey, I want to prepare for this. Yeah. I do see myself in a home, whereas before, like, no, I'm not going to do that application just yet. Not ready.
Yeah, so,
So I am seeing more optimism out there, and it's important that we help them understand. And it's just all about being well prepared.
Yeah, that's
good.
Know,
and everything we're doing is how we're talking to our clients is be prepared. Just prepare yourself. And all we're doing is we're going to create an action plan.
Yeah.
This doesn't mean that you have to move forward with this. This just means now you understand.
You have a plan.
Now you know what it looks like.
That's good.
It's an action plan.
That's real good.
G.I. Joe.
So
action plan.
Knowing is half the battle.
So before I get to the next topic I wanted to bring up, is there anything else that you thought about right now as our discussion happened that you've been hearing so far in 2023 that you were surprised by?
No, based off what Will said, that's where I kind of picked that one up, and I was like, oh.
Yeah.
Yeah, the other thing is that I am seeing is sellers reluctancy just to want to sell. Because what they're saying is, well, if I sell, yes, I have this ton of equity, but where do I go next?
Now, where do I go? Yeah, that's a good one.
Where do I go next? My payments with the rates that they currently are, they're at, my payment's going to be more than what I'm currently paying. So they're staying where they're comfortable right now, you know, and so it's harder to see people putting their house on the market as well.
I spoke to one of my clients that I was making my calls last week, and I talked to him, and he's like, hey, so in a few months, I want to buy FHA. He's like, I have my VA, but I have it in my current house right now. I want to rent this one out and buy a FHA property. And I asked him, well, why do you want to go FHA? He's like, well, it's only a 3.5 down %. And I'm like, well, why didn't you refinance your VA and then free and clear by, again? He's like, well, I have a 2% rate on it. So he's like, his goal is like, well, if I could refinance or I could just keep that rate, I'm cash flowing on it, right?
Yeah.
So I'm like, that's also one of the reasons why people probably don't want to move or make a change because of their payment being so low right now.
2%. They're like coasting.
Even if like, everything's crashing and burning, my $2,100 mortgage payment is still good. You know what I mean?
That's like free money.
It's at 2%.
Yeah, so it's so like
crazy.
There's some of those as well too.
I mean, I said so lucky, but it's not lucky, right? It's well planned.
Exactly.
Yeah. When the opportunity was there, he took advantage of that, and he knows an opportunity when he sees one. And there's not a bad thing with going what he's doing. If the formula works for him and it works, it's great, right? Because 100%. Then he'll cash flow on that rental as well.
Yeah, and then
help him offset whatever it is.
If anything wants, he could always refinance. But for now, that made sense for him.
Right now, so perfect.
Well,
that's great.
I emailed you guys about this in advance, so I'm going to bring it up. I want to talk about these real quick and get your opinion. First things first is we're going to talk about Bank of America. So Bank of America is pilot testing a new program with 0 down payment, no credit required mortgages. Sounds familiar in a bad way, right?
Yeah, but we already know what they're targeting and why they need to do that, right?
Yes. So problem number one, as I see it, is there's no qualification. Yeah. And problem number two is that if it fails, the people they're trying to help is the same demographic of people who they support the argument that, these people have higher default rates and higher foreclosure rates because of oppression in the system. But then they're creating this product that's targeting minority groups. Yeah. So what do we do about this?
I'll go. So, I mean, we talked about this before, right? And it came down to the education. If they're giving these products, they should have a very strict like curriculum to learn before you get into it, because they probably don't know what any of this means, and all they know is that, hey, I'm going to get into a house, I need very low qualifications, and all they know is that, yes, I'm going to get my family into the house.
Yeah.
But what they don't know is that if they don't know what they're getting themselves into, it could be a double-edged sword later down the line when they don't pay, where they don't know how to keep up with the maintenance and all that. So for me, it's like, if you're going to roll out these type of programs and you're already rolling them out in communities where we know aren't always the most educated when making financial decisions, how can we impede that by giving them education? And if they are able to understand it, then hey, now you do qualify for it. Right?
Yeah, I think the thing that upsets me the most about this particular idea is that there's not a component where we teach people credit
at all.
And this has been my number one concern about any minority-driven focused program, is it completely, or sometimes mostly, bypasses personal credit and budgeting. And I think that is such a disservice, because if you're going to try to support the minority communities, one of the best ways to do that is to help bring to the table solutions that are actually going to help people on their every single day life, not just achieve the metrics of your program. And so this program lowers the barrier for entry to home ownership, which is 100%. Fine. I think the effort is right in trying to help achieve more minority home ownership. That is 100% great. Yeah. The way they're doing it is where I have the problem. Yeah. I definitely think there's a lack of helping people understand what they're doing. And then again, I don't think they're doing it by design. But again, if it turns out and it fails that they have to they default and there's foreclosures, now it's a foreclosure in the same community that they're saying they're trying to help, and it could have been resolved by doing some soft qualification and education. Yeah. So this, to me, honestly, spells trouble.
Well, we'll see who qualifies, right? That's the other thing. One thing is announcing that they have a product.
Yes.
The biggest thing that's going to be, it's, can they qualify?
Yep.
100%.
Yeah.
That's going to be the key component right there. Is we could all see all these things. I mean, your CalHalfa.
Yep.
They have down payment assistance. They have community housing works. We see how it is. There's a lot of red tape that goes through this.
Yeah, that's right.
So a lot of times it could just be throwing the hook out there, just kind of baiting. Hey, we want to do a good thing out there. You know what I mean? And so let's show the CFPB and everybody else, that we're going to be doing a good thing to put ourselves out there, be being part of the community. But at the same time, this could be a disservice.
That's what I was gonna say. That, to me, that also comes across like, man, that's super disingenuous. Like you're just doing it to tick the box on the paper that says you should do this. It's like, man, that sucks. Yeah, that doesn't help the people that we care about either.
Exactly.
So
we'll see how that works out. I mean,
that's a great segue to the next thing, which is Wells Fargo moving out of retail mortgages unless you're their client.
Yeah.
So I know that some other banks and credit unions do this. Like, hey, if you're a member here, we'll do your car loan. Is that like, I get that. This is Wells Fargo, who has for many years benefited off the MBS securities and the market and having subsidies and being bailed out. Yes, Wells Fargo, I'm talking about you. So this is different, but I think that it signals that others could do this as like the market is forced to adopt changes. Yeah. I think that a big bank doing this is going to signal to other groups that they're going to have to. I just don't know that they can't.
Yeah.
Or I don't know that they can because they're not that size and they're not going to have the type of scrutiny or opportunities that someone as big as Wells Fargo does. Yeah. And for smaller banks that follow the same direction to reduce their risk exposure, this may also not allow them to have any growth opportunity either.
Yeah, that's crazy.
So I don't know how to play this one because on one hand, I understand why they may only want to do mortgages for their clients and their clients only. On the other hand, it reduces risk. Okay, great.
Yeah.
But it also is void of opportunity where you could be qualifying good loans and keeping them in your portfolio, which helps retention and helps keep money flowing and then thus reinforces your stock value and your earnings, et cetera, et cetera, et cetera. Yeah. So what do you guys make of this one?
Well, I really think one of the things that I heard is the CFPB keeps picking on them. When they need money, when I need money, who do I go to where I'm going to find some type of little discrepancy, right?
But that's always
who's just going
to always. That's what I was going to say. I'm like, when's the last time?
But here's the thing, I'm not defending the Wells, right? But this is what I heard. Like people who are not making the payments, it depends how you take that car back or how you make that note due. Yep. It could be something like that. And they're just going to go after it, but they went around it the wrong way, right?
Correct.
And so the person not making that payment for the mortgage, the car, or whatever they borrow from, it's like, well, they're just not making the payment, so we're going to get your car repo or do whatever needs to be done. The CFPB will just notice something that's not proper.
Right.
And now we're going to fine you $1 billion, $2 billion, right? I mean, these companies, so it's like
and he's not exaggerating.
It's like a target, you know what I mean? So they already know they're going to find something. So here you go.
Yeah.
So I think they rather say, you know what, we're paying too much money in these settlement fees that we have to find a new strategy how to go about this.
Yep, I agree. Their most recent penalty, Memo's not examinating, was $1.7 billion.
That's it.
In penalty. But
I think it had to do something with car notes or something like that. It was people not making the proper. They were not making their payments.
Yeah, it's actually here. It was automobile lending, consumer deposit accounts, and mortgage lending. So it was actually all three of those things cited, even though there might have been more things. Those were the kind of most notorious.
So guess who CFPB is going to go next?
Bank of America.
That's right. They're around. They're around. You know what I mean? And so that's the thing is who's going to be easy pickings?
Yeah. So, I mean, put it to you like this. If a lot of these big banks start to obviously, leave the mortgage servicing,
space,
mortgage space, what opportunities does that leave for smaller banks though?
Well, I don't know, but here's why. And here's the thing I don't think enough people are talking about. Part of the mortgage space relies on the mortgage-backed security market, which for a long time now has been subsidized by the government buying bonds, mortgage-backed securities. But remember, not only did the government stop doing that, now they're rolling them off their books, their balance sheet too. So you don't have the government's participation in the mortgage-backed security market, which is why they're saying it in these terms. They're saying, it's about risk mitigation. Well, their risk was, up until this point, their risk has been shared.
They don't got the
government's sharing in that. Well, the government's like, we're going to buy $90 billion a month of mortgage-backed securities. Well, okay, I got someone in on the fix with me.
Yeah.
But now I don't have someone in on the fix, and we're out. So part of it might be penalties, part of it is risk mitigation, part of it is like, hey, I don't have an appetite to share all this risk by myself. Yeah. So I think that's all weighing in on this right now.
Yeah, who knows? All I know is there's all these money that's being fed to the CFPB. I don't see nothing in our pockets. Do you, Andy?
No. And I think
I don't even know where those funds go to.
I do think that spells trouble for the smaller banks because I'm not sure if they're going to stick their neck out and assume full risk if there aren't market participants. I don't think they're going to assume full risk to do mortgages.
Right.
And I think this is what's going to have to keep an eye on. That was my big takeaway from this section of our talk was I think that's one of the things that as professionals, we're going to have to keep our eye on this year for our listeners and for our viewers because these kinds of things usually are signals for other changes that are to come. And this is one that caught my eye because it's with two big ones. It's B of A, number one. It's Wells Fargo, number two. Yeah. And as we watch this unfold, we're going to have to talk about this again. But I wanted to get some hot takes right away so we have reference for where we started this conversation and where it is in 3 months, 6 months, 9 months.
Nice. There you go.
Yeah.
No, I like that. Hey, we're not going anywhere. So we're still here. We got great investors. We didn't rely on both of those banks. So
we got our banks.
Okay.
We have our banks and this is all they do.
Exactly.
So.
Yeah. Exactly.
So that was it for today, guys. Is there anything else you wanted to just bring up real quick in closing?
This is all just great information. Again, hey, it's all about being prepared, right? Yeah. Prepare yourself. And, I know that we can try to predict what's going to happen down a couple of months, but the only way we're going to predict is by doing our due diligence of understanding,
right. 100%.
The market indicators. We'll understand what happens with the Fed meeting on the 1st. Yeah. All those things are going to really be, an opportunity to be better prepared and to make that next move. Yep. But I tell you, if you're in San Diego here, there's nothing better than buying a piece of land. Especially for our military people. Yeah. Hey, you already have that BAH. Yep. It's way up there. It's gone up this year.
Yes.
Take advantage of that and let that BAH pay your future.
Yep.
So what I mean by that, invest it in your home, your family.
And you guys just got a 12% raise. So, I mean, you can afford a lot more than some people here in San Diego.
Well, you're getting something that not a lot of the people might be getting.
Exactly.
That's for
some stations. Not all of them.
Not all of them. Yeah.
Let us know
when you're about San Diego, our micro market.
All right. Well, thank you guys for this conversation today. And thanks again for listening to the Mortgage Heroes Weekly Podcast. If you need help, you can reach out to us online at mortgageheroes.com, Facebook, Instagram, YouTube, email, phone, or text. Remember to share this show with the people you care about. We appreciate you, and we will see you again next week.
Yes, and welcome back, Andy.
Hey, it's good to have you back, Andy.
Yes.
We'll see you guys next week.
We like the brains.
See you guys next time.
Bye.